Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. Today's Fast Graphs Fundamentals Analyzer software tool video is going to be on the Dividend growth stock, Tanger Outlet. This is a real estate investment trust that owns and operates retail outlet malls, primarily on the eastern seaboard of the United States. And the real key here is that retail stocks in general, and Tanger specifically, have become significantly undervalued because everybody believes that Amazon will be the only surviving retailer in the world. And although Amazon is a great company, I doubt very seriously that all retail stores throughout this country are going to close because of Amazon. And the bottom line is risk and opportunity are sometimes equated. And I believe what you're seeing here with retail stocks is that the opportunity has been created because people see them as risky, and therefore the valuations have become compelling. And let me show you what I'm talking about. Tanger outlet malls are very exciting outlet malls that offer brands that people are really interested in and looking for, and therefore they're excited about going to these outlet malls where they can buy name brand goods at very low prices. And the company has done very, very well and has a pristine balance sheet, as I'll show you here in a second. However, before I do that, let's take a look at some of the real important fundamentals when you're dealing with REITs. REITs are primarily valued by what's called funds from operations. And funds from operations represent distributable income that REITs are required to pay by law. And when you look at Tanger here on an operating history and look back to 2000, you can see that they've generated very consistent funds from operations growth, averaging about 5.6% a year over the long run. But as I shorten this time frame, you can see that growth rate's actually increased to about 7%. But let's take the long-term perspective for a moment, and let's look at the company and look how stock price relates to the company's funds from operations. So I'm going to add monthly closing stock prices here. And you can see periods where the stock was trading significantly below their funds from operations justified level, and you can see that represented a great opportunity to buy the stock. And you can see periods where their stock price was significantly above their funds from operations, and those tend to be not so good times to buy the stock. And coming out of 2010, we had this long period of overvaluation. The company actually became pretty highly valued in July of 2016, but thanks to this Amazon threat, and I say thanks because I believe it's created an incredible opportunity, you can buy this stock at one of the lowest prices to funds from operations that the stock has ever traded at. Next, I want to take a look at dividends. If you look at their dividend record, it's been excellent. This company has steadily increased their dividend over the years by an average rate of about 5% a year. So had you invested $10,000 in December of 1999, you'd have received $1,174 in income in 2000. Last year, that income would have gone to $2,500, but you would have averaged over $26,000 in dividend income compared to an equal investment in the S&P that would have only paid you $3,000. So this is clearly a dividend income producer, but it's also a pretty good capital gains producer in its own right also. It averaged 9.6% capital gain versus 3% for the S&P, where you have a total return of 12%, or slightly better than 3 times better than the 4% you would have achieved in the S&P 500 over the same time frame. So let's shorten this time frame a little bit and look at what's been going on here in more recent times. The stock was very attractively valued in 2010, and that led to some really great performance, steady dividend increases. The dividend grew from 78 to 80 to 84 to 90 to 96 to $1.14 to $1.30 last year, and expect to come in at $1.35 this year. And the stock is now trading at a price to FFO of 11, and it historically has traded at a much higher price to FFO. But if you take it back to intrinsic value, over the next year and a half or so, a $10,000 investment in Tanger could easily grow to almost $15,000, or a 47.8% rate of return. So what's compelling today is the valuation on this stock. I believe it's extremely inexpensive, offers a 5% yield in a market environment where the market's only yielding about 2%, and long-term bonds, looking at the 10-year Treasury bond, is only yielding 2.3%. So this is an opportunity to buy an extremely undervalued stock at a very attractive valuation. Now, as I promised, I want to take a quick look at their balance sheet. Assets per share have grown dramatically in the last several years. Cash and cash equivalents have been strong, or in the last 3 or 4 years, coming off of some rather weak numbers before that, but their cash position is improving. Their common equity or book value has steadily increased over the last 4 or 5 years to over $7 a share. The company does have some debt, but as you can see here, a significant portion of their debt is long-term debt, and that's not unusual for a real estate investment trust. So I think the company has an extremely attractive balance sheet. But what I think is more important is looking at funds from operations compared to paid dividends. They're generating significant funds from operations coverage over their dividends, and I think that's critical. So I think the dividend is safe and intact. You can buy this stock today with a 5.3% yield and an opportunity to see that income continue to grow over time. But you also have an opportunity to buy this stock at one of the lowest valuations ever. I don't see anything really bad happening to their fundamentals other than the fear that something might happen. So I think fundamentals remain intact. The stock price is excessively cheap, and I believe that's a great formula for long-term investment success. This has been Chuck Carnevale saying thanks for watching.